Investing is a smart way to grow your money, no matter where you are in life or what your financial goals may be. It not only helps your savings increase over time, but also protects your hard-earned money from the effects of inflation, which can quietly reduce your purchasing power year after year. In Sri Lanka, you have a variety of options to make your money work harder for you, whether you're just starting out or looking to diversify your portfolio. This guide will walk you through these choices step by step, using a practical example of investing 3 million rupees, so you can see how your money could grow in real terms. Why invest at all? Because simply leaving your money in a savings account means it could lose value over time, as inflation steadily erodes its real worth. By investing, you give yourself a better chance to beat inflation and reach important milestones, like buying your dream home, supporting your children's education, or enjoying a comfortable retirement. Starting with 3 million rupees is a strong foundation, and it can open doors to many opportunities for you and your family. We'll keep things simple, using clear language and real-life examples so everyone can understand and feel empowered to take action. Sri Lanka's growing economy is full of new opportunities, from real estate to stocks and bonds, but it's important to remember that every investment comes with its own risks. Understanding both the potential rewards and the risks involved is essential before you make any decisions with your money. Our goal is to help you feel confident and informed so you can make choices that are right for your unique situation. Let's begin this journey together and make investing accessible, practical, and rewarding for you. Remember, your financial goals are unique to you. Investing is a powerful tool to help you achieve them, no matter how big or small. We'll show you practical strategies to invest wisely and effectively so you can make the most of every rupee. Now is the perfect time to start. Let's get going and make your money work harder for you. Welcome to your investing journey in Sri Lanka, where your future begins today. Sri Lanka offers a variety of ways to invest your money, each designed to suit different financial goals and comfort levels. Each investment option comes with its own unique set of benefits and risks, so it's important to understand what works best for you. Think of these choices as tools in a financial toolbox, each serving a different purpose to help you build your wealth. In this chapter, we'll focus on 5 main options available in Sri Lanka: savings accounts, fixed deposits, government securities, unit trusts, and corporate debentures. Savings accounts are the most familiar and widely used. They're safe, easy to access, and perfect for keeping your money secure while earning a modest interest. Fixed deposits, on the other hand, offer higher returns if you're willing to lock in your money for a set period. They're a great choice for those who want stability and better interest rates. Government securities like Treasury bills and bonds are considered very safe, as they're backed by the government. They're ideal for conservative investors looking for security. Unit trusts pool money from many investors and are managed by professionals, making it easier for you to diversify your investments, even with a small amount. Corporate debentures let you lend money to companies in exchange for higher returns, but they come with a bit more risk compared to government-backed options. Throughout this series, we'll explain each option clearly, breaking down the details so you can confidently choose what fits your needs and future plans. Remember, some options are safer and more stable, while others offer the potential for higher returns, but come with greater risk. Understanding these choices is the first step to smart investing, helping you make informed decisions for your financial future. Let's dive into each one in detail and see how they can work for you. After all, knowledge is your best investment tool, so let's get started on your journey to financial growth. Savings accounts are safe and highly liquid, but offer low returns, typically 5% to 7% per year. They're great for emergency funds, but not for long-term growth. Fixed deposits, or FDs, lock your money for a set period and offer higher interest, around 10% to 13% per year. FDs are low risk and protect your capital while providing steady income. Minimum investment for FDs is usually Rs. 25,000 to Rs. 50,000. Savings accounts are easy to open, but FDs are better for growing your money. Both are good starting points depending on your goals. Choose savings for flexibility, FDs for higher returns. Let's move to government securities. Government securities let you lend money to the Sri Lankan government, one of the safest investments. Treasury bills, T-bills, are short-term, maturing in up to a year, and offer yields around 9.5% to 11.5%. You buy T-bills at a discount and get the full value at maturity. Treasury bonds, T-bonds, are long-term, paying fixed interest, coupon, twice a year, with yields between 11% and 14%. Minimum investment is about Rs. 100,000. T-bills are very low risk. T-bonds carry some interest rate risk if sold early. Hold bonds to maturity for guaranteed returns. Government securities are ideal for safety and predictable income. Consider them for both short and long-term goals. Next, let's explore unit trusts. Unit trusts pool money from many investors and are managed by professionals. They invest in assets like stocks, bonds, and money market instruments, giving you instant diversification. Types include money market funds, low risk, 10-12% returns, income funds, medium risk, 12-15%, and equity funds, high risk, 15-20% or more. Minimum investment is often as low as Rs. 5,000. Unit trusts are great for beginners and those seeking diversification. Returns and risks depend on the fund type. Choose based on your comfort level. Always check past performance, strategy, and fees before investing. Professional management and diversification are key benefits. Unit trusts can help you grow your money with less effort. Now let's look at corporate debentures. 11. Corporate debentures are loans you give to companies in exchange for regular interest payments. They offer higher returns than government securities, typically 14% to 22% per year, depending on the company's strength. Higher returns come with higher risk. Companies can default. Minimum investment ranges from Rs. 10,000 to Rs. 100,000. Check the company's credit rating before investing. Higher ratings mean lower risk. Read the debenture prospectus for details. Debentures can boost your income, but always assess the company's stability. Let's compare risk levels across these options. Every investment carries some risk. There's no such thing as risk-free. Low-risk options, savings accounts, fixed deposits, T-bills, and money market unit trusts, best for capital protection and short-term goals. Medium-risk longer-term T-bonds, income unit trusts, and investment-grade debentures, balance safety and returns. High-risk equity unit trusts, high-yield debentures, and direct stock investments. Potential for high returns, but also higher losses. Choose based on your goals, time horizon, and risk tolerance. Low risk means lower returns but more safety. Medium risk offers a balance. High risk is for those seeking growth and willing to accept volatility. Diversify to manage risk. Let's see how you can put this into practice. Let's look at 3 sample portfolios for investing Rs. 3 million, each designed for a different risk appetite. Whether you're focused on preserving your capital, seeking a balance between safety and growth, or aiming for higher returns with more risk, there's an approach for you. The first is the conservative portfolio, which prioritizes safety and stability above all else. This is ideal for those who want to minimize risk and preserve their wealth. Here, 50% of your funds, or Rs. 1.5 million, go into fixed deposits, offering a steady return of around 11% per year. Another 30%, or Rs. 900,000, is allocated to Treasury bills, which are backed by the government and yield about 10.5% annually. The remaining 20%, or Rs. 600,000, is invested in money market unit trusts, providing liquidity and a return of roughly 11%. Altogether, this portfolio is expected to deliver an average return of about 10.9% per year, with very low risk and high peace of mind. Next, the moderate portfolio strikes a balance between safety and growth, making it suitable for investors who want some exposure to higher returns without taking on too much risk. In this approach, 30%, or Rs. 900,000, is placed in fixed deposits, earning about 12% per year. 25%, or Rs. 750,000, goes into Treasury bonds, which are slightly longer term and offer a return of 12.5%. Another 25% is invested in income unit trusts, with Rs. 750,000 targeting a return of 13.5%. The final 20%, or Rs. 600,000, is allocated to investment-grade debentures, which can yield around 16% per year. This diversified mix is expected to generate an average return of about 13.3% annually, balancing growth and security. Finally, the aggressive portfolio is for those who are comfortable with higher risk in pursuit of greater rewards and long-term growth. Here, 10% or Rs. 300,000 is invested in long-term Treasury bonds, offering a return of about 13.5%. The largest portion, 40% or Rs. 1.2 million, goes into equity unit trusts, which can potentially deliver high returns of around 18%. 35% or Rs. 1.05 million is allocated to high-yield debentures, targeting a strong 20% return. The remaining 15% or Rs. 450,000 is placed in income unit trusts, with an expected return of 15%. Altogether, this aggressive mix could yield an estimated average return of 17.5% per year, but remember, higher returns come with higher risks. Choose the portfolio that best matches your financial goals and comfort with risk. Smart investing means more than picking products. It's about strategy. Consider taxes. Some investment income is taxed, affecting your net returns. Always aim for returns above inflation to grow your real wealth. Liquidity matters. Know how quickly you can access your money. Diversify. Don't put all your money in one place. Review your portfolio at least once a year. Your goals and market conditions change. Adjust your strategy as needed. If you're unsure, seek advice from a qualified financial advisor. Investing is a journey, not a one-time event. Stay informed and proactive. Your ideal mix depends on your goals and risk tolerance. Make your money work for you. Happy investing in Sri Lanka.